Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Judd Hirschberg. Judd is president at White Wave Trading, a trading company and our partner for trading research consulting services at Cedar Gold. He's run proprietary groups and has 47 years of trading experience. He's developed some awesome indicators and an approach for trading the financial markets. That's what we'd like to explore today, how he does that, and some examples on what he does. Welcome, Judd.
Thanks, Richard. It's great to be back.
Great. Let's delve right in. If you can give us a broad overview on some of the techniques that you use, matrix numbers, risk spreads, technical analysis, how it all comes together, the big picture.
Okay. So basically, I'm a pragmatic technician, and I've developed a repeatable process gauging market risk. Market moves are not random, and when instruments align, I play a match game, what I call a match game. And at major market turns are always identifiable. The setups are pretty much always the same, but the reasons vary. And when things match up, currencies, bonds, indices, commodities all align for major market turns. They don't move independently. A little bit about the work is that it's not short-term work. It's quarterly work that I've been doing for over 40 years. And what I do is I create a quarterly bias where I have a hard number, and above it, it's good, and below it, it's bad. And it's pretty simple concept. So just to give you a couple examples here and how I put this together. You've heard Ira Harris talk about, SPU bond spreads. I call them risk spreads. And here's a picture of the S&P monthly 500. And just to give you an idea how markets come to these numbers, in 2016 on the monthly, on a big break, we came down. There was a number at 1811. The low is 1804 and a quarter. We rallied 200 and some points. The next month, we came all the way back down, made a lower low by 2 points, and took off for a major market move. In 2018, Ira wrote a piece. I think it was the end of September, the 1st of October, that he was looking for a big market turn. And we had a double top at one of our numbers that we generated, and we had a huge sell-off. And this low again was another matrix level. It went through the number by a few handles, but held the 50-month moving average and took off again. So that's just one of the indicators we use. Now take a look at this. This is the S&P bond spread. This is a pit spread, which means that the data goes back to the inception of the S&Ps, which was 1982. And I'm gonna expand this chart again for you so you can see what I'm talking about. But here's the 99-2000 high. We had a big break. We came back up. In 2017, we broke above this 1999-2000 high. The S&Ps are trading at 2,500. Ira and I were, he was doing a live panel with Rick Santelli, a couple other people, and he said, the S&P bonds just broke out. And that is the October 18th, 2000 high in this spread. matching up with that 2944 level that I just showed you in the S&Ps on the monthly. So we take the spreads and we take the outrights to telegraph a lot of these bigger moves. And I told Santelli, said I was bullish. I said, yeah, I'm bullish. You want to know where the market's going? And he goes, yeah. I said, 2965. You looked at me like I was from Mars.
Yeah. Is there any input into this process from a fundamental analysis perspective? Like, for example, if IRA has a particular view geopolitically or in the economy, do you use that as input into the process?
Never. And the reason I don't is because the fundamental story changes after the technicals do. Now think about that for a second. You know, we started this up move in the S&Ps off a major low while everybody was still had a fundamentally bearish view. And we've just rallied 3,000 points in the NASDAQ, almost 1,000 points in the S&Ps, and everybody's still giving you a bearish argument. So I always rely on the risk spreads and the quarterly numbers that we generate for a trading bias, because I know that markets move from one of these levels to another. It's just in the nature of how things move. Mm-hmm. And this last high this year in the end of March was the same type of setup. It couldn't trade the 2018 high in the spread. And we generated another matrix level, and it was above it. It hit my S&P target, and the whole thing collapsed. So we take the risk spreads and we match them up with the straight indices to tell us what's going to happen. Now you can see it a little bit better. On this, and you can see this chart goes back to 1982. So that's when the S&P first started trading, and the opening range of the S&P futures was 116. We're now trading at 29,072. So think about that. So these levels are great indicators to tell us if there's more or less upside or downside. Now, once we started closing below this level from the breakout level from 2017, well, we had a whole nother big leg to go down in the S&Ps. And everybody was asking me, is this the low? And it was simple. It wasn't the low. We just had to wait for it. But I knew because of looking at the risk analysis that it wasn't the low. And I wasn't in any hurry to buy. And when people don't have a repeatable process, they're just going to say, well, I'm just going to start buying because I don't know where the bottom is. And they're going to keep on buying. For our methodology allows us to sit back and buy with a much better risk profile. All right, now I'm going to show you one other chart because I want you to see the difference. Oops, that's not the one.
And these matrix numbers, is this like a proprietary approach that you have developed over the years in coming up with those matrix numbers?
Yes. So data matters in this world. Now, if you're using the mini S&Ps, your data only goes back to January 97. So it's going to be very hard for you to see the bigger moves. So that's why we use, the more data you have doing these studies, the better off you are. And I do it in currencies, bonds, all the interest rate futures in Europe, anything that a future has got, is attached to, we do this work for. And then we overlay the big cap tech on top of the model. And I'll show you what I'm talking about. You can see Apple coming down on the quarterly when it broke down. And we weren't looking for we were, here, let me move that over because it wasn't the right one. Here, right there on the quarterly. Mm-hmm. I was looking for the quarterly stops to get run under 215 to match up with that last matrix level low in the S&Ps on the last break. And Microsoft did the exact same thing. It went down and got the stops under the previous quarter's low and then took off. So what we'll do is in my room is we'll take these matrix levels, the risk spreads, and match them up with big cap stocks that are market leaders. And they'll all align at the same time. It's uncanny.
Wow.
You know, Amazon will, Google will, Apple, Microsoft, all the big names all line up at the same time. And you can do this across all asset classes, whether it's copper, oil, it doesn't matter. They all seem to line up together. So it's a repeatable process, and we just keep doing it over and over again because it allows us to make, to articulate a direction with limited risk. And the whole idea about the business is risk management.
Yes. And to what extent do you make use of these other indicators shown in different colors, perhaps some kind of momentum graphs or in the different colors, yellow, blue, green?
Well, these are just big moving averages. Mm-hmm. Hold on a second. Let me get you another page. Let's just take the S&Ps. So this is the 50-week. This is a 21-week moving average in the S&Ps. And so I keep my, all this does is I use a simple moving average. I use the typical ones. The Aqua is the 50, the 200-day. This green line is, I like cloud studies. It was developed by the Japanese, and it's called One Look because it tells me where the market is in one look. You know, when it comes back down to the top of the cloud, it's support. If it's coming up into the cloud, it's initial resistance. So, you know, it'll keep me out of trouble visually. You can see where the 200-day moving average is in the S&Ps. It's 29.97 and a quarter. So I'll use long-term point and figures. You you can see on my screen, here's NASDAQ bonds. NASDAQ bonds here had a big bullish pattern today. S&P bonds have a bullish pattern. My short time frame charts are 240 minutes, and then I use long-term point and figures. So, and I keep it very simple. It's very simple. I stay to my template, I stay to my game plan, and I try not to get off script. And you've been in the room. We talk about a lot of different things and a lot of different scenarios. And then we try to find ways to make money on those.
What are the indicators currently for what is potentially happening short term?
Well, just today, it's copper. Oh, wrong one. I need the July. There it is. And this is something Ira bought this last night after he talked to you.
Right. Yeah. Okay.
So, it just took off.
Yeah.
And if you listen to the conversation on Friday, he'd been long platinum because it's an industrial metal. And if they're going to start manufacturing cars or everything else, that was going to outperform.
Yep.
And there's the platinum, above its 200-day moving average. Above its 200-week. And I have some pattern recognition indicators built into my my software that gives me a heads up when things are in play. So it just gives me the added vision to know where to look. And that's really helpful. So this is one that I think has got a lot of upside to it. And then, we go, you've heard us talk about all the, here, let me pull up the, silver for you. Just give me a second here. I have to get on the right input. Okay. This is silver and euro. And silver and yuan looks pretty close to it. Now you can see how this has been going sideways for 5 years. And it's just on the verge of starting to go. So this is one of the guys in my room have been long silver miners, gold miners, gold. They started adding, some of the guys have been adding platinum. We looked at some of Peter Bookvar's favorite names today, like SCCO Copper. We looked at BHP. I know that so I'm looking at this to break out.
Yeah. And then you have some matrix levels, matrix numbers that show potential upside. Oh,
yeah. Markets move from one of those numbers to the next. So the beauty about a matrix, following the matrix work, is that you don't have to do a lot of work. You just have to refer to the sheet and know where the market's going to try to go. Mm-hmm. And when it gets to that next number, then you can start matching it up. You know, some people do Fibonacci work, some people do whatever work they want to do. You know, I don't bother doing it anymore. I just know where the market's going because I can look at my sheet. I know exactly what number it wants to print at.
Okay. Yeah.
You know, unless it closes below the previous number, it's going to the next one.
I see. Right. Okay.
It's as simple as that. When, you know, I don't put any more thought into it than that. And it's always, you know, I'm very pragmatic about it. It's repeatable. It works. It's worked for 45 years. I know it sounds innocuous to somebody that's just listening to it and they go, you know, I'm not buying it. But it's something that, you know, I've watched work for 45, 46 years. You know, I know it works. And comments from, you know, people that have come into my room and bought my work or bought my courses, you know, the comment was, well, you know, it took me 3 months to start to begin to understand what you were saying. Then I started to see what you were talking about. Then I bought the work and started paying attention to what you were talking about. Then I took the course, and these guys have made a lot of money.
Yeah.
And the executives especially love it because they don't have to be in front of the screen all the time. They just know that all they have to do is do their homework and trade at the levels.
And so this approach can be applied to a number of whatever commodities, securities, and then you look at bonds, everything that could then present a high probability approach.
Oh, here, one of the guys in the room, just to give you an idea, started buying bonds down in here in 2018, 30-year treasuries. He bought more there was another one of those matrix numbers here in right around 155 or 156. He bought more there. Uh-huh. He got out, I think, at another matrix level around 167. So he made almost 30 full bond points.
Okay.
On his original buys.
Yes.
You know, and he had a view that interest rates were going down and central banks were losing control, and he just kept buying bonds for his clients. He's an RIA. He only trades at matrix levels, period. He does not trade anyplace else. There's no in-between trading. There's no thinking for him. You know, he's got it down. If he's going to put on a Russell short or a hedge, it's at a matrix level. If he's taking them off, he's looking to do it at the next matrix level. He's very methodical about it. He's made a lot of money.
And when looking at different securities or commodities, bonds to do the trade, would there be some indicators that could give an indication of a higher probability relative to other potential trades? Well,
you know, you have to decide. I guess that's a little subjective because there's always another way to do the trade. Mm-hmm. Whether you want to articulate it through bonds or you think it's better through equities or metals or whether you don't want to buy gold outright. The gold has been a much better trade in euro terms or in yuan terms than it has been in straight dollar terms. And for the longest time, everybody didn't realize that gold was rallying, not in dollar terms, but in everybody else's terms, it was having a massive rally. Mm-hmm. So many people discounted what the gold was doing because they don't look at at how it's denominated. And that's, you know, Ira's forte.
And what is the time horizon like for the shortest period of time versus the longest period of time that you can use this approach?
Well, that is, that's an interesting concept, because the last 2 months, volatility has been so high. We've seen periods where we've gone from one matrix level to the next in the S&Ps, and sometimes those numbers have been 150 S&P points apart. And we've seen it in a 6-hour or a 12-hour period. Sometimes we've seen 2 or 3 round trips in a day.
Wow. Yeah.
So that's a function of volatility.
I see.
And in the 2017 rally, it was low volatility and it was a grind. It took an entire year to get to where we thought it could go.
Wow.
So, it's kind of a loaded question, and it's really predicated on volatility. The more volatile it is, the better the numbers work. And they're always going to the next one. I put out something in the oil. Let's see. When it went negative.
Right. Yeah.
It was trading around $17, and I thought it was going to go to $2. I put out a $2 target. It went to $2. I didn't realize it was going to go negative $40.
Right. Yeah.
But then, I had a level of $10 that got generated, and I put it out that was going to be it. And it had a big bounce off. It came all the way back down, retested it, and that was the low. So that was the same type of thing you saw in the S&Ps in 2016, where they went back to that low. Here, they gave you another chance at that low.
Yeah.
And all my guys had it, and this low matched up with the name and all the low and all the oil names. So you take the work in the commodities, and then you extrapolate that to the names you want.
Wow, yeah, this is pretty powerful. Gives that edge, as you mentioned. And operationally, it works where you have a trading room. In the morning, you set up and you have a discussion amongst the participants on how the financial markets are behaving for that day.
Oh, and a lot of my RIA. Well, I've got a huge cross section of clients. I have people that are short-term trading. I have some terrific options traders. I have a large group of RIAs, and they trade differently. Some of them are buy and hold. Some of them are opportunistic, especially since, they don't have to pay the commissions anymore. So a lot of these guys have become more active.
I see. Yep.
But they all use the same methodology. And once they've learned my methodology, all they do is come in and ask me about trade location and different instruments. We talk about names. We get into the sectors, the names within the sectors that we're trying to dig out. We try to ferret out the best names. And what's nice about it is that, IRA comes in and everybody starts, throwing around names. And we have people that do fundamental work, which I don't do. And that's a great conversation, because then I'm just going to put the technical side to it and see where we can, what the risk is to do these trades.
Right.
Sometimes it's not apparent. Sometimes they just get up and go.
I see.
But it's all risk reward for me.
Yep.
Risk management.
And you start off the day putting out some ideas of what's happening, like some email distribution. They get missives throughout the day.
Yeah. At night, I write a daily market intelligence report,
Mm-hmm.
and I'll put out, a few names, the indices, maybe the commodities I think are in play, or the metals, whatever really interests me that I think has potential. And then in the morning, I'll write just a few lines to try to bring that all together. And it's not a big report. I'm pretty brief because I ran a trading group, and I came from a floor trading background. So the communication, it's not long-winded. It's just a few sentences, and people like that brevity. And if they have questions, they'll ask me, and then I'll follow up. But most of it now we just do in the room. And I have people coming in, in and out all day, and they'll ask me questions. One of the guys, one of the RIAs from Chicago, he picked out the Apple low. He came in and he said, Judd, can I buy an Apple here? And then I started to go through the progression on the Apple chart, and sure. And it was the day that it went and ran the stops below 215. And we were trading around 221. And I said, David, it's going to go down here and get the stops under 215. I mean, it didn't come all the way down here not to go. The algos are going to go and try to elect those stops and see what's there. I mean, that's just the way the algorithms work. So you can see where they want to go on the chart. And once they put in a low and they start coming back up through this previous low, that's where you can buy them and put in a tight stop and know where you're wrong. That was a stone cold low. It was the same thing. He asked me about Apple and he asked me about Microsoft that day. They both had the exact same patterns.
Wow.
And they both did it at the same time, matching a matrix level in the S&Ps. It's not independent. They all happen at the same time.
Yeah. Well, this is great and fascinating. And how can the listeners learn more about this service and how to get into it?
You can go to whitewavetradingstrategies.com, click on my website, and all you have to do is put your name and an email in, and I'll put you'll get a 2-week free trial. And that does not include the matrix numbers. And you can come in and check out the conversation and see what it's all about for yourself.
Wow, that sounds great. Thanks very much, Judd, for this insight and the introduction to the service.
Richard, thanks a lot. I always appreciate your time. I love your podcasts are so fascinating.
Thank you so much. Yeah, thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.